Hey everybody, Chuck Barone here. Back at my desk Wednesday, June the 14th, 2023. Wow, a lot of stuff's happened since I was last here last week on Friday. A lot of news to talk about with you guys, some stuff I haven't had a chance to comment on. I want to apologize, first of all, I got stuck in a continuing education class. I thought for sure I would be able to get these videos out, but the instructor was one of those guys who didn't want to let you out of the class, hardly even to eat lunch. So it didn't work out. But I'm back today, and we'll be back. I don't have another one of these for a long, long time now. So you'll be getting sick of this mug. Anyway, before I get rolling on the show, just like to welcome everybody. Thank you guys for your support. Watching these videos every day and doing what you guys do. We can't tell you how much we appreciate you guys. All right, so let's look at this market today. So we knew today was the day that Powell and the Fed would make their announcement, and they did. As we kind of have been expecting and been predicted on the show, they did their pause or skip or whatever you want to call it for this week. So markets reacting to that news, as well as a pretty tame PPI number, the Producer Price Index, coming out today, very mild, right in target, really pretty much on target with where the Fed wants things to go. PPI is important because it signals where consumer rates or consumer inflation will be going down the road. It's kind of the foreshadowing of the CPI numbers. As the PPI has come down, so has the CPI. CPI number is pretty good. You come in at 4%, down from 4.9. Still a little bit tough where it counts the most in the core inflation. Food and energy are going to gyrate all over like always. But inflation looks like the Fed having their way. But anyway, so these markets today, mixed market on the stock market. I don't think everybody really has digested everything that happened today with the Fed. So the market's kind of mixed. The Dow dropping 232 points, 33,979 on the Dow. The S&P squeaks out a small gain, up 3 points, 43.72 on the S&P 500. NASDAQ up 53, 13,626 on the NASDAQ. So stock market not really responding very much to this day. I think that as the market digests the news, gets into the nuts and bolts of Powell's comments in his presser, as the Fed yo-yos get out speaking their mind, how they do, we get a little bit better of an idea. Market placing its bets, the whole idea of Fed rate cuts this year pretty much seeming to be off the table. Now people speculating that, and the Fed actually coming out with their predictions, expecting the Fed funds rate to be over 5.5 by the end of the year. That would require at least 2 more quarter point increases, 1 more. It's a 0.5 point more than where we are at 5.1 right now. So it's interesting how the market going to digest this news, because the idea of Fed rate cuts coming this year probably out the door. Bond market today kind of mixed. As bond yields come down a little bit for the 10-year, down 4 basis points at 3.79%. The 2-year basically flat today, down fractionally hundredths of a point at 4.69%. So you have a 90 basis point inversion, almost back up to 1 full percent. This is not, this inversion, we're going to have a regular economy. We're going to get back to normal. We needed this inversion to be uninverted, and we need it to go away. It just seems to be getting worse is the problem. This is an indicator, although obviously, just like we learned last year, not a 100% indicator that recession is coming. It's so hard to predict right now because all the information is so mixed. Some businesses still doing very well. Wall Street beating earnings predictions pretty regularly. Businesses hiring, even though the unemployment rate is squeaking up a little bit like the Fed wants it to. So the bond market kind of whipsawing around, not knowing exactly where to go. We've seen it, we've been watching these bond market for a while, laughing about it, because you see it just gyrating up 15 basis points one day, down 15 the next, all over the place, literally having no direction. So it's fascinating to see. And now let's see how the bond market really digests this Fed news. I would think that if they really believe the Fed's going to continue to raise rates this year and not cut, we'll see rates jump from where they are. The dollar today down very small, 103 even on the index. Still a strong number for the dollar. Actually coming back down to earth a little bit though, was up over 104 last week, but coming down, still a good number. And the dollar, staying strong, putting a little bit of pressure on metals. Gold today coming down $2.90 per ounce, $1,940.40 for an ounce of gold. Silver actually gaining today. Silver up 23 cents per ounce, $23.86. I'm liking silver here, guys. I like gold too. I think, silver easily going to leap past this 25. Gold going to get past 2,000. These are the benchmarks, the round number benchmarks, I guess, that are coming next. Both have already been above these before. Now they got to go through the dance before they finally break through and stay there. Oil today down again. Oil market having some difficulty, down 68 cents per barrel, $68.74 for a barrel of West Texas Intermediate. I think that oil, as I've been telling you guys, oil trending down. It has broken out now. It's been very comfortable, it seems, in this trading range between $70 and $75 per ounce. It'll break out every once in a while above it, below it, but it seems to snap right back into that trading range. So while we have a temporary reprieve on oil here, I do believe it won't be long, and we'll see oil back in that trough between 70 and 75 per barrel. Bitcoin today down $778, $25,115 for Bitcoin. Number coming down a little bit. Bitcoin, I think, truthfully, holding up pretty well, all things considered. SEC issues in crypto, the ongoing problems with fraud and, chicanery. You got the foreign entities in there hacking. So Bitcoin, in spite of all the negative around Bitcoin and cryptos in general, Bitcoin holding up okay. All right, so let's look at where things are. Let's get into some commentary here today. So, the way things are going right now couldn't be better for the Federal Reserve. Things are working out pretty much exactly as best as they could possibly hope. Now that we know they've raised interest rates for 10 consecutive committee meetings until today broke that streak. CPI has come down from its peak at 9.1% last summer, clocking in today 4%. PPI 2%. Wow. So you have, the inflation numbers, while they're not exactly where the Fed would like those numbers to be, numbers coming down pretty significantly from their peaks. Employment slowing down. So today was, completely the way we expected it to be. We've been telling you guys we expected the pause today. But the interesting thing was that when they announced that they weren't going to raise this meeting this month, they did talk pretty consistently about this is not the end of the rate hike cycle, talking pretty tough, trying to do their best to make the market understand that this is not a pivot to lower rates. Lower rates are not on the table, at least so far, what they're saying this year. So it's going to be interesting that let's see how the data moves and how the Fed reacts to that data. They've had it pretty easy, truthfully, they've had it very easy. The market's responding exactly like the textbook says they should, which did not happen in 70 and 80. We'll see if they can keep their lucky streak going here. But I think sooner or later, these numbers start working against the Fed. There's an upset somewhere. And now the reality of all this has to set in. Typically, that doesn't happen until the Fed moves to start cutting rates, right? So we're nowhere near that yet. But we'll see if this pause, what kind of reaction the market has to the pause, how they read the pause, right? Now, this sad thing is, though, the pause here is not really going to provide any relief to consumers who need it so bad. Rates won't go any higher. That's true, they won't go higher this month, but they won't go any lower either. And that's where we need things to go to take some pressure off some of the stuff that's getting smacked, right? So, don't expect to see rates coming down for mortgages. because they're probably not going to. They're not going to come down on car loans or credit cards. And this is really where consumers need some relief. These higher rates are putting a very strange kind of pressure on real estate, where the higher rates are just crushing commercial real estate. As we've been talking about on the show, they got $1.5 trillion of commercial real estate loans that are due to be paid off or refinanced by the end of 2025. So that would be basically a $500 billion between now and the end of the year, $500 billion next year, $500 billion in 25. That's if nothing else gets added on. So very difficult right now because the rates for commercial real estate financing are about double what they were when these loans were taken out. So now you got big trouble there because landlords, number one, they're faced with massive vacancies in their buildings. Now they have that Hobson's choice of, do I want to refi, take a giant, much higher payment than the payment I have, even though I'm having difficulty making the lower payment I have right now. Very, very difficult for commercial real estate. It's going to be amazing. We'll be keeping our eye on that for you guys, bringing you up to date. But at the same time, having a completely opposite effect on regular residential real estate, where what's happened is these low, ultra low interest rates, most people who own a home and have a mortgage on that home are pretty savvy about their rates. So when rates went down to the low threes into the twos, everybody refied down to those rates. Well, that was wonderful and is wonderful, a great break for consumers. But now they're basically a prisoner of their mortgage because they don't want to sell that house with its 3% mortgage. And even if they're downsizing and going to take a significantly smaller mortgage, in many cases they end up with a higher payment than they would if they stayed right where they are. So, people don't want to sell, and I wouldn't either. That's driving real estate price, supporting the prices on real estate. If it was a normal market and buyers and sellers were normal, it was a normal rate situation, commercial real estate wouldn't be in the crush they're in. Residential real estate would have room in it for first-time buyers to get into the market. Not as it is right now. So, with this restricted supply, it's supporting higher prices on real estate, keeping prices up. As I've been telling you guys, we don't have a match here. You got high prices and you got high rates. That doesn't work for real estate. If you're going to have high prices, you have to have low rates to support those prices so the payments are payments people can actually make. If you're going to have high rates, that's fine, but you have to have a price correction then to support those higher rates again so people have payments they can live with. Because of this weird conundrum where people locked in these ultra low rates, you're not having that adjustment. Real estate actually on the way back up now, and because of this lack of supply, you're getting back into these bidding wars with ultra competitive, multiple offers on single properties, and even with these higher prices, still getting multiple offers, cash offers. Crazy times in real estate, man. So what do you guys think? Now, the question comes next is, okay, what do they do next month? What happens in July? Well, I gotta say, my opinion, for what it's worth, I really think that the Fed would like this cycle to be over. I don't think they want to tip their hand that way to the stock market because the stock market would blast off like a rocket ship if they did. And they might have to still continue to cut rates or to hike rates depending on how the data comes in. But I would say, as it stands right now, I would lean toward another skip in July, especially if the inflation numbers continue to come down like they are or have been. So we'll get through all of this. We'll be back again tomorrow to bring you guys up to date, to give a little bit more commentary on some of the stuff I missed. Again, I apologize for missing on Monday and Tuesday. I was stuck and couldn't get away. I have no way to really create a message to let you guys know I'm going to miss. But anyway, back again. Here I am, guys. I appreciate your support. We'll be back again tomorrow to give you guys the news you need. We'll see where the market goes. It should be a fascinating finish to the week. We appreciate you guys. As always, if you like what you're hearing, please hit the like button. It helps to change the algorithms at YouTube, gets our video in front of more people, gets us more views. We would appreciate that. If you have questions, ask them in the comment section. Of course, your comments are always welcome. And we will be back again to bring you guys the news you need tomorrow. Until then, my friends, take care. Thanks.